This presentation provides an update and analysis of the operation of property markets around the globe. It is important to understand that all property markets are subject to the same market and societal forces, the result of which is a cyclical movement upward until the stress of high asking prices for land carries forward into the overall economy and a crash occurs. The depth and duration of the crash is, to a significant extent, a response to the actions, constructive or otherwise, taken by government. While it is true that all real estate markets are unique because of local factors, it is also true that all real estate markets operate under the same basic fundamental economic laws. People need places to live and to work. Neither housing units, office buildings, storage facilities, or any other type of structure can be constructed without a foundation attached to land, even if the land is covered by water. For a typical single-family detached residential property, builders use a rule of thumb that they will acquire and develop land only if they are able to sell a finished residential property for at least 4 times the land acquisition cost. Thus, when a quarter acre of land costs $100,000, US, Canadian, or Australian, the type of housing built will be fairly large and amenity rich, offered to buyers willing and able to pay at least $400,000. Of course, there are no guarantees that between the time a builder acquires land, obtains all necessary building permits, lines up construction financing from a bank or other financial source, and completes construction that the demand for the end product will be there. The amount of profit, if any, depends, all things being equal, on timing. Where is the project completion in the above property market cycle? Lower cost housing units can be constructed if the community provides the land at a heavily subsidized cost or the community permits higher density development. Of course, many such developments sell exclusivity, particularly when centrally located in city centers or other locations where gated communities limit access by the general public. For residential property markets in the United States, the most referred to data comes from the Case-Shiller House Price Index, developed by Carl Case, Professor of Economics Emeritus at Wellesley College, and Robert J. Shiller, a Professor of Economics at Yale University. Notice that property prices remained fairly steady from about 1960 until the mid-1970s. Then the price of land increased considerably as the baby boom generation became young adults and as new suburban communities pulled millions of households from the nation's urban cities. A shortcoming of this index is that it fails to show what has happened to the land to total value ratio for residential properties, a ratio that proves to be a very accurate indicator of the health or stress of individual markets in every community. Property markets historically are relatively stable where land to total value ratios are no greater than 20%. Under these market conditions, banks that required a cash down payment of 20% were financing housing units, while the property purchaser was paying cash for the underlying land parcel. Equity in the home occurred as mortgage debt amortized. Equity in the underlying land parcel occurred as the demand for land allowed landowners to charge whatever the market would bear. Interestingly, in many countries, there is a strong desire by people to return to urban living because of the access to cultural amenities and other institutions. An increasing number of people are choosing to live in cities where the use of an automobile is, for most activities, not needed. When households with higher incomes compete for existing or newly constructed housing, land prices are pulled upward. A frequent consequence is that households with lower incomes are forced to relocate to lower cost areas. In some areas of the United States, there is no available affordable housing, whether to lease or to purchase. Another shortcoming of the Case-Shiller Index is its failure to compare rising property prices against household incomes or factor in the cost of homeowner insurance and property tax obligations. Affordability is determined by the extent to which these variables are increasing in relation to one another. Mortgage loan underwriting takes these other associated factors into consideration to determine creditworthiness and the level of debt a household can reasonably carry. In the United States, until property prices began to skyrocket upward, prudent mortgage lenders limited the amount of credit approved to what could be carried within 25% of the borrower's household income. And that ratio included not only the interest and principal payment, but funds escrowed to pay for fire insurance and to cover local property taxes. These safeguards gradually disappeared in response to property prices that increased far faster than household incomes. The challenge to banks and investors who made or purchased mortgage loans was how to respond to the need for higher and higher loan amounts while managing the increased risk. Affordability is a huge challenge in most countries. Take the United Kingdom. A report issued in December of 2015 by the Resolution Foundation, analyzing data gathered by the Bank of England, concluded that nearly one-half of respondents living in rented housing or with family indicated they had no hope of ever being able to purchase a residential property. The authors noted that it would take around 24 years for a low to middle income household to save enough to meet the cash down payment requirements of mortgage lenders. In October of 2017, Britain's Conservative Party announced plans to channel an additional £2 billion into the construction of 25,000 housing units. This raised the government's commitment through 2021 to £9.1 billion. However, this commitment barely scratches the surface of the need. Much of the rental housing stock in the UK is in poor condition. Some 4.4 million private sector dwellings are rated by affordable housing advocates as non-decent to live in. In the United States, the property markets and the mortgage investment sector have overcome the forces of recession, even as land prices have returned to the 2006 peak levels in many parts of the country. This has been facilitated by historically low mortgage interest rates. As the inventory of unsold properties put on the market after foreclosure or newly constructed housing units that could not find buyers was absorbed, seller markets returned. In the Netherlands, after 5 years of declining property prices, the market turned upward. Rising property prices in the Netherlands have driven up total mortgage debt to approximately 664 billion euros in 2016. The price increases began in 2013 after falling by 21% in mid-2008. A Financial Times analysis of Europe's residential property markets released in mid-2016 indicated that residential mortgage debt outstanding was twice the total disposable income earned by households at the end of 2015. Thus, about 30% of Dutch property owners experience negative equity. In October of 2015, the Global Property Guide described the residential property markets in the Netherlands as finally recovering. The article provided the following analysis of the underlying regulatory factors. Homeowners receive favorable tax treatment. Aside from full income tax deductibility of mortgage interest payments, capital gains from rising house prices are also not taxed. However, this is partly offset by an annual imputed rental income tax based on the property's assessed value. According to a recent report issued by the National Association of Realtors in the United States, the affordability of residential properties continues to decline in most metropolitan markets. At the beginning of 2017, Bloomberg produced a study of over 400 metropolitan property markets around the world, comparing affordability on the basis of a ratio of median property prices to median gross incomes. In markets where property prices exceeded 5 times income, the market is considered severely unaffordable. This chart identifies the 10 least affordable markets around the globe. What this aggregated data does not reveal, however, is the mismatch existing between regions in every country where property costs are low but unemployment is high, compared to regions where property costs are high and even increasing, where unemployment is comparatively low. Even in the United States, the range of average property prices is wide, as noted in a 2017 analysis. Of the 25 least affordable housing markets, 16 are located in California, with many clustered around the Silicon Valley area. Many people move to these areas for the specialized, high-paying jobs available. However, even with some of the highest incomes in the country, typical housing costs are well out of reach for most residents. In many countries, large parts of cities and even entire regions that once boomed with economic activity are in decline, as businesses have closed down or relocated in search of more desirable facilities and higher profit margins. Those residents who can do so follow, leaving behind the poor and the elderly. This chart looks at the rising cost of residential property in Hong Kong. After a steep decline in 2016, residential property prices rebounded in 2017, increasing 23%. Despite the highest prices in the world, demand remained strong throughout the year. Though fearful of a burst in the property bubble, government and financial authorities had no success in slowing the upward climb. The land tenure system is unique, as the entire special administration region remains owned by the government. Leases are sold for the capitalized value of land, which is then subject to a modest annual ground rent payment. The high prices for residential property is an indication that Hong Kong's government is collecting in public revenue only a very small portion of the potential annual rental value of land held under lease by private individuals and entities. The net imputed income is capitalized by market forces into a selling price for the leasehold interest, the primary reason for the high cost of living in Hong Kong. From the perspective of property investors, the huge infusion of cash into the global monetary base softened the downward trend in property prices that began in 2007. It is noteworthy that an overall decline of around 1/3 from peak values still left much of the gains in land prices that occurred since the mid-1990s. This chart reflects the global markets most at risk of another major correction in property prices. Analysts also identify urban growth boundaries as a reason for unaffordable land and property prices. Such restrictions on land use prevents, or at least mitigates, sprawling development in the countryside, but also drives up the value of land where development is permitted. Brookings Institution economist Anthony Downs observes that such boundaries can convey monopolistic pricing power on sellers of land. Back in 2004, Downs wrote, "Constraining outward movement of growth might cause housing prices to rise sharply, penalizing renters and prospective new home buyers." What Anthony Downs reported would have been more accurate if he had replaced the word housing with land. Even under conditions that impose few restrictions on development, the price of land is driven up by hoarding or holding land for purely speculative gains. The supply of land is further reduced by decisions to protect current agricultural use, to preserve wetlands, to set aside habitat for animals or plants, or establish open space for parks and recreation. We know all around the globe property markets have been disrupted by the foreclosures resulting from high unemployment. The impact on the lives of individuals and families is harsh, with homelessness on the rise even as the number of vacant residential properties soars in many communities. Yet despite the combination of all these factors, some construction of new housing units continues. What is rather interesting is to look at the correlation between construction permits issued and actual housing starts. The fact that in the United States permits and starts closely tracked is a clear indication that builders broke ground only when a property was under contract by a purchaser approved for mortgage financing. Nowhere else around the globe is the bizarre consequence of flawed public policies more evident than in China, where speculative property construction has resulted in a huge number of empty cities that now dot the Chinese landscape. A report issued early in 2017 indicated that over 50 cities continue to experience high vacancy rates. In the city of Shandong, for example, huge skyscrapers remain empty even as new construction continues. As this chart indicates, the Chinese are far more vulnerable to a crash in property values than even U.S. households. Just how much has already disappeared is difficult to assess. Most property investors come from the top 10% of Chinese households who receive 60% of income. An increasing number of these individuals are investing in property outside of China, where demand remains high and the potential for capital gains, that is, gains associated with rising land prices, continues to be more certain. It has taken a longer time for land prices in Japan to climb to levels that once again threaten the country's economic stability, but the actions of the current Japanese government have added fuel to the speculative fires that drive all property markets. The impact of low interest rates and readily available credit is reflected in the upward climb in residential property prices since 2012. Japan's condominium markets have steadily climbed, and land sales have also been rising in the nation's major cities. At the same time, Japan's aging population forecasts a significant oversupply of residential property with each passing decade. A global property guide analysis released in mid-2017 indicates there are an estimated 8.2 million unoccupied properties in the country, some 13.5% of all residences. In North America, property prices continue to climb in many metropolitan markets, none faster than in Vancouver, British Columbia. The average selling price for a residential property has remained stable over the last 3 years at $1.3 million. In neighborhoods on Vancouver's west side, similar properties have sold for an average of over $3 million. Regulators have attempted to slow the price increases by adopting tighter criteria for mortgage loans. One side effect of this has been to increase competition in the rental market. The situation in other metropolitan regions across Canada is not much better. The high cost of rental housing makes it increasingly difficult for individuals and families to save enough for a down payment to purchase a property. An even more troublesome picture is reflected by the fact that nearly 1/4 of all condominium units in Vancouver were vacant or leased to tenants in much of the central city. A significant number of properties have been acquired by foreign investors, some purely to be flipped without renovation or being offered to tenants. Other properties are owned by individuals who work and stay in the city during their work week rather than commute long distances to a suburban home. The situation is described by urban geographer David Wachsmuth. The problem in Vancouver is that demand for housing doesn't have that strong of a relationship with the local economy, which means that prices are out of whack with what people who live and work in the city can afford. In response, Vancouver is imposing a 1% municipal vacancy tax. So far, the tax has not influenced absentee owners to sell their properties to owner-occupants. Some have put ownership of units in the name of one family member and rented the unit to another. Owners of second homes have been the most vocal in opposition to the tax, arguing they should be exempted. The 2016 census indicated there are over 25,500 housing units unoccupied or occupied temporarily. The problem in Vancouver is the same problem that exists in almost every other city or town in every country. Some significant portion of working individuals do not receive an income sufficient to absorb the cost of a residential property and have enough income left over to meet other basic needs. Even in wealthy social democracies such as Canada, people are forced to choose between paying for housing or feeding their families. What too few of us understand is that the problem is how government at all levels raise public revenue. The economic literature on the subject is extensive, if largely ignored by those who have the responsibility for public policies. The result has been a continuous redistribution of income and wealth from producers to a non-producer rentier elite. Economist Michael Hudson described the process at the 2015 conference at Peking University. The second leading factor leading to economic crisis was more long-term: Ricardian land rent. Landlords and monopolists levied an ownership tax on the economy by extracting rent as a result of privileges that were independent of the mode of production. Land rent would rise as economies became larger and more prosperous. More and more of the economic surplus would be diverted to owners of land, natural resources, and monopolies. These forms of economic rent were the result of privileges that had no intrinsic value or cost of production. Exactly how serious this problem has become is described by British economist and author Fred Harrison. Today, governments are not free to institute the one reform to the financial system that would enable people to resolve the crises of the 21st century. Global underemployment of labor and capital, debilitating mass poverty, suicide on an epidemic scale in southern Europe, planetary degradation of natural habitats, all are symptoms of a pathological social structure. The guardian of that structure is the culture whose agents are embedded in the seats of power. Privatization of the resources that communities formerly shared between their members was consolidated in property rights which undermine the vitality of humanity. When rents are not pooled for the common good, all spheres of existence are automatically ruptured and degraded. Until we act as directed by Fred Harrison and others, until we look to the value of land, whether agricultural, mineral-laden, or the land parcels in our towns and cities to provide the revenue to fund public goods and services, property markets will continue to drive our boom-to-bust economies. Achieving this fundamental and systemic change is key to a future where every person will have access to decent, affordable housing and to a living wage. As Albert Einstein so aptly advised, we cannot solve our problems with the same thinking we used when we created them.